Welcome to the African Allocator Podcast. My name is Chipo Muwowo, and my guest today is Nerina Visser. She's a director at ETFSA Portfolio Management Company based in South Africa. Nerina, great to have you on the podcast. Thank you so much for joining me today.
Hi, Chipo. Thank you so much for the opportunity. I'm really looking forward to our conversation today and to share some insights with the listeners of your podcast.
That's fantastic. Really great to have you. Today we're going to be talking about ETFs, or exchange-traded funds, really well known globally, dominated by the US, but really growing in Africa. And I'm really excited to hear a bit more about what that market looks like in an African context. And Nerina's an expert, so yeah, really great to have you. But first, Nerina, I'd love to hear a bit more about how you got into the investment world. Tell me a little bit about your story.
So, Chipper, mine is a bit of an unusual one, I guess. I did not have any form of finance or investment or accounting or economics background. My undergrad studies was a BSc in applied mathematics and mathematical statistics, and I started out my career working in the defense industry in South Africa. This was way back in the late 1980s. And I worked for a company who, at the time, South Africa was designing and building an attack helicopter. And I was part of the team that designed the weapon system for the attack helicopter. And the weapon system, amongst other things, included rocket launchers. So I often say tongue-in-cheek that I started out my life as a rocket scientist. And so when I say to you that investments, in particular investments in ETFs, is not rocket science, I actually know what I'm talking about.
Absolutely.
But you know what? I really have to credit my husband for getting me into the investment industry. At the age of 30, I had just had our third baby, our third child, and I thought I was going to become a full-time mom and a caregiver and a housewife. But my husband knew me really well and just sort of nodded and smiled and said, "Whatever, darling, I know." And it was actually, he was painting the baby room and was putting out newspapers to cover the carpet and the floor, and called me over and said, "I have a job for you." And I thought he meant I needed to come and help with the paint job. But it turned out that he saw an ad for a quantitative analyst at Old Mutual Asset Managers, as it was at the time. Now, I just need to highlight that I could not even pronounce the word quantitative, never mind that I didn't know the first thing about what that would entail. But it was a great job advertisement in the sense that the focus was on the qualities, the skills, the attributes that the successful applicant should have. And the more I read it, the more I realized that actually my husband does know me very well. It spoke about things like, the attention to detail, the love for modeling, the numbers, of course. And yes, that's where I started. And I guess the person who really took a major leap of faith was the person who appointed me at Old Mutual at the time. But for me, getting into the investment industry was love at first sight. I absolutely loved it. And it was only after I started working in the industry that I then first did an MBA, and I then followed it up with my Chartered Financial Analyst, my CFA charter holder designation. So very much a roundabout way, but that was another 30 years ago. So I guess I can now say that at least half my life I have been in the investment industry and still loving it every single day.
Yeah, fantastic. Now, I know that you wear many different hats, non-exec director for an investment firm, and you do some stuff with your representative with the CFA Institute. I think that's the President's Council representative for Middle East and Africa.
That's correct.
But you're also a director at ETFSA Portfolio Management Company. Tell me more about the business, and then, tied into that, tell me more about ETFs. What are they?
Yes, let's maybe start with that. What is an ETF? Now, for me, it's all in the name, exchange traded fund. And the key components there is, first and foremost, exchange traded. So it tells you something about where one would buy, where you would access this investment instrument. It is traded on a stock exchange, and that's your access point. The second important part is the F for fund, which means that the underlying investment that you're buying is a fund. And in most markets, that typically mean a fund along the structure of a mutual fund or a collective investment scheme and so on. And so for me, that beautifully captures the essence of what an ETF is. What you will notice is that nowhere in that name does it say anything about tracking an index or being so-called passive. And yet for many people, there is the default association that an ETF is a so-called passive investment. And we can go into a bit more detail on that later on. But it's almost a misnomer, because the ETF industry globally has moved on substantially from the early days, 35 years ago, when ETFs were indeed large, broad, market cap weighted equity ETFs and index tracking portfolios. But today it represents so much more. And so you asked me about ETFSA Portfolio Management Company. So we are financial advisors and discretionary fund managers, and we manage portfolios and funds for a very broad range of clients, both institutional and retail clients, but with an explicit focus on only using exchange-traded products as the underlying investment instruments that we use in the portfolios that we manage. And it really sort of highlights two key areas of differentiation in terms of what we do and how we do it. The first one is the custody of those investments. Because we're only dealing with exchange-traded products, it means that your custody and ownership effectively resides with the stock exchange and with the electronic share register of the stock exchange. So it presents a very different fund administration and asset administration process. But the second thing is that because there are so many different varieties of exchange-traded products available, we are able to build customized, very unique, bespoke solutions for clients according to their objectives, their investment mandate, and so on, only using exchange-traded products. And so the bulk of the portfolios that we manage are global multi-asset portfolios that cover all asset classes, that cover all geographies, that cover all sorts of different underlying investment styles, and we do so all just using exchange-traded products.
What are some of the key characteristics of ETFs? Now, I know you're a fan, obviously. What's your sell? Why should people invest in ETFs?
So I often use an alternative interpretation for the letters E, T, and F. For me, the E also stands for efficiency. An exchange-traded fund, because it is a single investment that you make that gives you access to a whole diversified basket of underlying assets, you get significant efficiency. With that also comes cost efficiency, and the cost efficiency often is not only about management fees that are significantly lower, but the fact that you're really getting that package deal, almost the transactional efficiency of it. So for me, the E is about efficiency. T, which is equally important, is transparency. ETFs are by their nature transparent investment vehicles, especially if they are index tracking products. But even many actively managed ETFs provide full disclosure of the underlying portfolio. And so for an investor for whom it is really important to understand what is inside this fund in which I'm invested, the transparency of ETFs is really a very powerful selling point. And this goes all the way from highly regulated investment vehicles like retirement funds, for example, that have restrictions in terms of the underlying holdings, all the way through to younger generations of investors that are increasingly wanting to know, where is my money being invested? Am I comfortable with where my money is being invested? And so they really embrace the transparency that you've got in it. And the final one, the F for me, is about flexibility. Because ETFs are really equally suitable for small and large investors, and because they trade intraday, every single day on stock exchanges, that guaranteed liquidity that you also get through the market maker or the authorized participant or the liquidity provider, any range of names that one can use for that function, that guaranteed liquidity that you get means that it offers you a very flexible investment instrument for a portfolio. So those are some of the key differentiators for me, and why, yes, I know I'm probably talking my book that I say I'm very much in favor of ETFs, but I do think those particular characteristics make them highly desirable and very good for a broad range of investors and investment objectives and mandates.
I'd like to talk about the South African market specifically now. Firstly, your company, what exposure does it have to South African ETFs versus other African versus international? Can you just give me a bit of a sense of that before we talk about the SA market?
The industry. Sure. So in terms of our company, probably around 80% of the assets that we manage, we do via the Johannesburg Stock Exchange. And when we talk about the South African market, we'll come to the fact that we manage these portfolios using JSE listed exchange traded products. Doesn't make it South African exposure. But yes, about 80% of it is managed onshore on our local stock exchange. But then we also manage portfolios for clients in international markets. Our preferred stock exchange for two reasons. The one is that, of course, there's the time zone alignment that is very suitable for us being based in South Africa. But after the US, the UK, and certainly the London Stock Exchange offers the broadest range of ETFs that are available. And I must also just add to that via the London Stock Exchange, we're able to trade in any market in the world. So we from there trade on Euronext, we trade on NASDAQ, we trade on the New York Stock Exchange and so on. So we are not restricted by domicile because the accounts are held and the trading is done on the London Stock Exchange, but it is a very convenient, let's call it investment platform and custody account for us. And yes, so about 20% of our assets as a business is actually managed in those offshore markets, and therefore that's obviously full sort of hard currency portfolios also. So those would be dollar-based portfolios or pound or euro. We can operate in any number of different currencies.
How's the South African ETF industry changed in the years that you've been involved? Obviously, Satrix is probably the best known ETF provider. Give me a sense of how that market has changed over time. And I guess as well, do you get the same breadth of ETF strategies as you get in the US? So I feel like you could probably, if you had an ETF on anything, you could probably find one. Is what we see in particularly the US market reflective in the SA market as well? Or is it a bit more vanilla?
So certainly not vanilla, but certainly also not the range and scope that you have with the US. But let's maybe start just with a little bit of the history of the South African industry. And you're quite right. Satrix, not only the first ETF provider, but also the biggest one and remains so to this day. So we celebrate 25 years of ETFs in South Africa this year. And so from those very early days of a single ETF, which it's the Satrix 40 ETF, it's certainly quite a well-known brand and name in South Africa, even beyond the investment industry. But from that single one that tracked the JSE Top 40 Index, in other words, the 40 largest shares on the JSE in the South African market. And from that, we now find ourselves that we've got an industry with 280 exchange-traded products on the JSE, around 250 billion rand of assets. But what is interesting about this has been this evolution of what do we have. So I'm going to try and do it fairly briefly, although it is quite a comprehensive industry to cover. But from those early days, starting out with the top 40 ETF, and soon afterwards was followed by some sector ETFs that Satrix launched that covered the mining sector, the financial sector, the industrial sector, and so on. Probably a very important feature, and I think especially also in the African market, was the listing of the ETFSA New Gold ETF in the year 2004. So it's also 21 years old this year. And in fact, it was the first physically backed gold ETF to be listed in the world. It preceded even its global counterparts. Now, what was quite interesting about that was that gold is not an allowable asset to be held in a collective investment scheme in South Africa. So the Collective Investment Schemes Control Act, CISCA, I guess the European equivalent would be UCITS. For many people, the familiar name would be maybe mutual fund or unit trust or whatever. And in terms of what types of assets may be held in such a collective investment scheme, physical commodities is not allowed. So at the time, the JSE said that they would look at the asset structure that holds the physical gold bars. And if it has the same form and structure as that of the collective investment scheme trust they would classify that as an exchange-traded fund. And so the important criteria were there that you would be looking at physical backing, you would look at ring-fenced insolvency remote asset pool overseen by an independent trustee and custodian, and all of those are in place not just for the new gold ETF, but for other ETFs that also fall into that category where the underlying assets would not be allowable investments for collective investment schemes. And to this day, commodity ETFs represent quite a substantial portion of the JSE ETF universe. In fact, almost 25% of it at the moment is physical precious metal commodities, so gold, platinum, palladium. And considering the history of the South African economy as well as the stock exchange, it makes sense. But the other major development really came with the introduction of offshore referenced or international or global ETFs as the underlying. And those also have been around for a very long time. But as regulations have changed over time, the ability for South African ETF issuers to offer global ETFs as the underlying assets have expanded dramatically to the point where more than half of all of the ETF assets on the JSE are foreign referenced. And it covers the full spectrum of asset classes. So yes, you have equity ETFs, you have fixed interest, bond, even money market ETFs, you have listed property, and also a variety of investment styles. We have dividend, for example, we've got infrastructure, so great thematic investments and so on as well. So when you look at the makeup of the South African industry, less than a quarter of the industry actually is on South African assets or local assets. So it tells you something about how that sort of range of investment options have opened up the universe for South African investors in terms of being able to access other markets than just South African equities really efficiently. Even the introduction of interest-bearing or bond ETFs and to some extent also currency ETFs and listed property ETFs and so on have also expanded the range significantly, and why we are able to build these global multi-asset portfolios using just exchange-traded products. The final evolution that I also just want to highlight happened less than 2 years ago, and that was when the JSE updated their listing requirements to allow actively managed ETFs to be listed on the JSE. And that is certainly an area where we are seeing significant growth. And I think quite useful to understand that in the South African context, you either have a pure index tracking portfolio, in which case you have to do full replication of the underlying index. Or if you are not following an index or tracking an index, the ETF automatically gets classified as an actively managed ETF, even though the underlying investment style might not be particularly active. You might, for example, have a strategic asset allocation multi-asset portfolio, but because it doesn't track a multi-asset benchmark index, it is deemed an actively managed ETF rather than an index tracking ETF. And yes, it's early days in that, but we see significant growth, and we believe that there's a lot more potential also in the South African market. So in terms of both the range of products on offer, but also where and how investors, especially professional institutional investors, use these exchange-traded products in their investment solutions.
Is there a danger that you end up with too many ETFs? And from an investor perspective, as they get more creative or exotic,
yeah.
I guess the on one level the risks increase. Yeah, how should investors navigate this growing area with this growing number of products? What's your comment on that?
Chipo, I think it's a very valid question. I guess we talk about the dilemma of choice, and that you sometimes find that people when they have too much to choose from, it leads to inaction because they just feel overwhelmed by it. So let's maybe put the 280 exchange-traded products into the context of two alternatives, if I can put it that way. In terms of unlisted unit trusts or mutual funds, there are almost 1,700 available in the South African market. When you look at listed shares on the JSE, there are now less listed shares than there are exchange-traded products. So on the one side, you have a shrinking traditional exchange market, and it's not just a South African story. This is very much a global story. But when you see the exchange then fulfilling more of a role as an investment platform, as I can call it that, where you get highly regulated, very secure, transacting in investment funds, suddenly the role of the exchange becomes quite different. And when you then look to the other side, to the mutual funds or the unit trusts that are available in South Africa, it's significantly harder to choose amongst those because there are so many of them. And certainly there's a lot less transparency compared to what you have in the ETF industry.
Sure.
Is it possible that one could have too many? Of course you could. But at the same time, for me, it's not so much the number that you have, but rather what is the variety? And when I look at the variety of what's available on the JSE, there are a few of the sort of the flagship indices like the S&P 500 or the MSCI World, where we do have multiple issuers offering exposure to exactly that same index. And there you could argue, why should you have more than one? Why is one not enough? But I do think that there's sufficient differentiation between the range of products at the moment that we're not anywhere near the too many point. But at the same time, it does mean that as both product providers, so ETF issuers, as well as those of us who are in the industry really focusing on education and awareness around this, our job gets harder and harder in terms of helping clients understand and navigate how to make investment decisions looking at funds, exchange-traded funds in particular, rather than maybe buying individual shares or buying sort of managed portfolios of funds on the other end. So, it's getting more complex, but just maybe to come back to the point that you raised earlier regarding, sort of relative to the US, I think it's really important for the listeners to understand that actually the US is a very unique ETF market. And in fact, there's quite a bit that happens in the US and that's allowed in the US and that makes ETFs in the US very attractive that does not apply anywhere else in the world. So be really careful not to take your understanding of the US ETF market and assume that the rest of the world looks the same. For example, things like leveraged strategies, inverse strategies, synthetic strategies, and so on. It represents a small number in terms of the AUM in the US market, but in terms of the number of products, there are a lot of those. And often when we see negative news flow around the ETF industry out of the US, almost invariably that's where it comes from, because I think investors find it very difficult to understand the payoff profile. The second area of differentiation is that the US has got a very unique tax benefit in the ETF structure compared to the mutual fund structure. So there's a lot of conversion from mutual fund to ETFs in the US taking place, and it's largely driven by the tax benefits that you get in the ETF structure. In South Africa, our ETFs and our collective investment schemes, our unit trusts or mutual funds, have exactly the same tax treatment. So there's no additional tax arbitrage or opportunity. And similarly, I think for investors looking at ETFs and other markets, I think it's really important to familiarize yourself with what is the state of that particular market and what does the regulatory framework look like, in particular in terms of what is allowed, how is it sort of regulated and managed, and not just to assume that the sort of the heavy news flow that we get from the US necessarily applies elsewhere in the world.
Yeah, that's a point well made. No, I totally agree. Let's talk about the state of other markets, other African markets. So South Africa is obviously the most developed, has the most developed ETF industry on the continent. Can you please just speak to the broader African market? What are you seeing? What other markets are seeing growth in ETF issuance? And, what are some of the unique challenges, I guess, of ETF growth in Africa?
So I mentioned the ETFSA New Gold ETF before, and it really has been the flag bearer for ETFs in Africa because without exception, other than the South African market, the JSE, the first ETF to list on every other single stock exchange on the African continent was the ETFSA Gold, the New Gold ETF. So this ETF basically started the ETF industry in many other African markets through a secondary listing of the ETF that was listed on the JSE in those other markets. So that was a really great way to get the industry started because for many of the stock exchanges, they needed to put in place listing requirements. They needed to put in place sort of the necessary regulatory framework for that and so on. But gold, physical gold, is such an easy to understand concept in terms of investment. So it wasn't a hard sell in terms of what is it that I'm investing in. Whereas just about every single other ETF, you would have to also consider, would the investors actually understand what it is that they're buying, what they're getting themselves into? So as much as the New Gold ETF was the flag bearer and opening up the access, we've seen significant growth across the African continent, most notably in Nigeria, where several domestic ETFs have come to market over the last decade plus. And it's probably I won't say the only market in Africa, but the strongest market in Africa in terms of developing their own domestic ETFs. And I'll come back to why it's been so difficult in so many of the other African markets to do domestic or homegrown ETFs. Mm-hmm. When you look at markets such as Namibia, for example, so Namibia operates, so the stock exchange operates off the same technology than the Johannesburg Stock Exchange, plus the Namibian dollar is pegged to the South African rand, so there's no currency implication. So it's been really easy for South African ETF issuers to go and secondary list their ETFs on the Namibian market. And so we've seen Satrix have done that with several of their global ETFs, the MSCI World, the S&P 500, MSCI Emerging Markets, and so on, but also One Invest, which is part of the Standard Bank Group, their commodity ETFs also. So the gold, the platinum, the palladium, and so on is also listed there. But in Namibia, we've already seen two local underlying exposures, but interestingly enough, both in the interest-bearing space. So Satrix has got a Namibian bond ETF. So Satrix is still the issuer, so not a Namibian issuer, but it's the underlying is Namibian bonds. And then very recently, there was a Namibian money market or short-term interest rate instrument ETF that was listed on the Namibian exchange. And so I can go around the continent, and I with that include Mauritius as well, where we've seen many other markets where ETFs have been listed. What have been the major challenges around that? I think twofold. The ability to have a domestic ETF is challenged by the lack of liquidity that we have in the underlying market, and whether that underlying market is equities or whether it is fixed interest, government bonds, for example, the lack of liquidity really causes a big challenge to the traditional way in which the ETF instrument operates. So that's been a specific challenge for African markets. I think probably the biggest demand for ETFs on the African continent would be for foreign, global, offshore referenced ETFs. But many African markets have either exchange controls or challenges around Forex access. And so they run into that type of brick wall in terms of how do we do this? It's interesting to see that in South Africa, one of the big where our ETF industry seriously took off was when the global market was opened up more extensively to local investors, and where the regulators as well as our Reserve Bank proactively became involved in terms of opening up that access. And I think there's a great lesson in there for regulators, financial market regulators in the rest of Africa. Because if you think about it, there is already quite a bit of money in Africa that is invested in markets outside of Africa. But currently, that money all not only physically is invested in those foreign markets, but all the benefits, the value chain benefits of the investment process accrues outside of the continent and accrues outside of the country. So by bringing those offshore investment opportunities back to your local market, even if those underlying investments are still invested in the S&P 500, for example, by bringing a big part of the investment value chain and the support services around it back to your local market, as a country and as an exchange, you're able to capture much more of the value that is created in that industry to your local market. But in order to achieve that, the regulators need to be proactive in terms of facilitating that type of access. And it's a work in progress. You know, this is never something that's going to change suddenly or overnight, but we have seen significant progress on this front, and hopefully with a lot more to come in the foreseeable future.
Where are you seeing significant progress in terms of regulation? You know, are you able to mention specific countries, perhaps?
So what I'd like to maybe also focus on is maybe just how Africa has often leapfrogged technologies. Let's think of telecommunications. This continent of ours is too vast to lay down fixed line telecommunications. So Africa never did fixed line. We went straight to mobile. And the mobile telecommunications industry in Africa is significantly better developed than most other parts of the world. And it's for me a great reminder of how proactive we can be when we come up with African solutions for African problems. So I'm going to talk about two areas where I think there's areas of development. Where we are currently seeing quite a lot of interest in the African markets is in tokenized assets. So this is still relatively new in many other markets, but some of the African stock exchanges are already in the process of updating their listing requirements to allow tokenized assets to be listed on the exchange. And tokenized assets can give you exposure to quite an interesting array of underlying investments. I guess where we often see this being used is, for example, in private equity funds. So you are bringing some of the private market to the public market via tokenized assets by using such a mechanism. And if you think about it, an ETF wrapper or a structure is actually a form of a tokenized asset. I know I'm sort of taking quite a bit of artistic liberty here in my description, but it's really a digital representation of ownership of something underlying, and that something underlying can be quite a broad variety of things. And so this is an area where I do think Africa has got the opportunity to take the lead in terms of transforming its capital markets, but specifically its stock exchanges, to actually incorporate that. That's one aspect. The other one that I think is also a very interesting and unique opportunity set in the African market is that we know that the bulk of retirement assets, pension fund assets in Africa, are held in the sovereign bonds of its own countries. But those bond holdings are typically what I would call dead capital. So government issues bonds, the pension fund buys the bond, it puts the bond in the bottom drawer, it receives its coupons twice a year, and nothing is done with the capital of that money. It was capitalized once, government got the money, used it, and that was the end of it. And typically the approach of an ETF is that you need liquidity in the underlying before you can create an ETF. But we've seen some really interesting ways in which other developing and emerging markets and even frontier markets have addressed this, most particularly in India. We've seen some examples of this in Latin America. We've seen some examples in Indonesia. And I'm going to talk about the South African example shortly as well. But where you can basically wrap a whole basket of such illiquid assets into an ETF, and in that way make the vehicle available to the market, bring more liquidity in through the vehicle, and in that way almost create more liquidity in the underlying. Why do I say the South African example? many, many years ago, more than 15 years ago, South Africa government started issuing inflation-linked bonds. And inflation-linked bonds were exceptionally illiquid. They hardly ever traded in the secondary market. And RMB at the time decided that they would like to launch an inflation-linked bond ETF. But with no liquidity in the underlying, that was a major challenge. And so what they did was they went to government and they said, would you be prepared to issue bonds into the ETF structure for us if there is demand for it more than what we have in terms of the size of the ETF? And government said, absolutely, we would love to do that because that creates an additional almost distribution mechanism for them for these inflation-linked bonds. And so RMB was able to bring that inflation-linked bond ETF to the South African market long before there was sufficient liquidity in the underlying inflation-linked bonds. And so this is another way in which I think regulators, not just the central banks of the African markets, but in particular also the financial market regulators, need to think differently about how do we, and I'm going to repeat the phrase, have African solutions for African challenges. I'm not even going to call them African problems. They're African challenges, but I think they are very elegant and amazing ways in which we can provide solutions that would be win-win. You know, it really would provide much better investment access for investors, very well regulated, very safe, but it also provides the government a wonderful additional distribution model in terms of those underlying government bonds.
Outside of South Africa and Nigeria, which other countries have interesting things going on? You know, yes, it's a long road to, you know, having a really thriving ETF market, but, you know, yeah, where are there interesting things happening? Maybe on a regulation front or
yeah. Oh, I'm gonna try and not leave out any, but I probably will be leaving out some examples. But seeing that you started sort of on the regulatory side, so I'm going to highlight the Nairobi Stock Exchange in Kenya. They are probably the furthest along in terms of the tokenized assets, but they are also a key player in the East Africa capital markets. And between Kenya, Uganda, and Rwanda and Burundi, we've seen a lot of work over many years in the harmonization of financial market regulations, really facilitating cross-listing between those different stock exchanges. So for me, that's been a really interesting one to observe and see how do they actually make things work on a regionally harmonized basis. I've already mentioned Namibia, where we've seen some of those local market products come to market. Botswana was one of the first ETF providers, stock exchanges, to offer ETFs also in Africa, and I believe that they are on a roll of where there will be quite a lot more product coming to market this year. Mauritius is another really interesting one because they have a multi-currency platform. So from an African perspective, that's quite a unique perspective in terms of not just a range of products available, but also access for investors, both in Mauritius, but also other external investors using Mauritius as a conduit to get access to different investment products. And yeah, those are probably some of the most prominent and well-known ones. It's certainly an industry that continues to grow across Africa, but we do have this need for more, almost, as I say, proactive and facilitating regulatory work to go on. I know that there's quite a bit happening in Rwanda. I know that Malawi is busy doing some work. The Eswatini Exchange is doing some work. So at the risk of creating expectation that might still take some time to play out, I don't want to go into too much detail, but there's certainly a lot happening on the African continent.
Fantastic. I've just got two more questions. The first is about investor education. When you just talk about investing in general, I think there's still a great need for education. When you talk about ETFs specifically, you know, there are more unknowns in a lot of people's minds about ETFs. So what are you seeing in terms of education? You know, how are companies, maybe even regulators, professional associations engaging in better equipping investors to know how to navigate
So education is absolutely fundamental, and it covers a very, very broad spectrum from institutional to retail investors, but certainly then also regulators in terms of this. So the type of education that I think is probably something which is needed across the industry, not just for ETFs, is almost helping people to identify how do I evaluate investments beyond past performance. There is, we always have the standard disclaimers, past performance is no guarantee of future results. And yet, because past performance is probably the most readily available bit of information and statistics about an investment, that's what people tend to look at. So it's not just about telling people don't look at past performance, but rather to say, well, what else should they be looking at? So I think a very important aspect around that is to help people understand why it's so important not only to look inside the investment fund, and this would apply to ETFs, but equally to mutual funds, unit trusts as well, not only to look and see what is inside that fund in order to determine what type of, sort of return profile I can expect, but to understand what are the rules, the decision-making process around that fund. Now, when you're talking about an index tracking fund, that means evaluating the index ground rules and the methodology. Now, that's not something that they ever teach you in business school or in investment management courses or whatever. They teach you how to do an ECF and a cash flow and a net asset value and a present value, but nobody tells you how should I analyze an index and a set of index rules to determine what might be in my index and what will drive the performance of that. So that's quite a key aspect for me. But even beyond indices, we certainly know globally that there is a massive growth in what I would term rules-based investment decisions, or in almost structured, programmatic, and those are typically run off rules. So I think it's about understanding the rules of the investment, how those decisions are being made. And I love, for example, using the example of dividend strategies to help people understand how to think differently about this. So dividend strategies are a very popular active management strategy, but it's also one of the easiest strategies to convert into a set of index rules and actually create a dividend index. And they come in two forms. You get your dividend payers, and then you get your dividend growers. Now, if you think about dividend payers, if my index rule says, like, for example, the Dividend Plus Index on the JSE, I'm going to select the 30 companies out of the top 100 that has the highest forward dividend yield. I exclude the real estate or the property companies from that, but these are my rules. Take the top 100, exclude the property companies, pick the 30 companies with the highest forward dividend yield. That's my basket. That's my index. But not only is that my constituents of my index, the next thing I do is those 30 stocks are they not weighted according to their market cap or their size, they weighted according to that forward dividend yield. So if I'm an investor that is looking for a strategy or a fund that's going to pay me high above average dividends, I can immediately see the link between that index rules and my objective that I have, which is to identify high dividend paying companies. The dividend grower strategy is a different one. It talks about the consistency with which companies are able to grow their dividends. So the S&P Dividend Aristocrats family of indices is a great example of this. In the US, for example, companies need to pay growing, increasing dividends for at least 25 years before they qualify for inclusion in that index. So now again, I can say to myself, what type of company can pay consistently growing dividends all the time? Well, they better have a good quality balance sheet and lots of cash flow generation. Also, if they needed to have done this for at least 25 years, I'm necessarily talking about older, more mature companies. So it means I'm not going to have any of the young upstart fly-by-night type of companies that might at the moment be shooting the lights out. This is a lot more consistent and solid and quality that I'm buying. So helping investors understand that is the approach to making investment decisions, choosing investment products, because you've got to find the match between what are my objectives? What am I trying to get out of this investment? And where will that drive come from? What is going to drive that performance? But this is not easy education, and especially when it comes to and not just retail investors. We often find that institutional investors, it's even harder to educate them because they so often come with all these preconceived ideas, or it's like, don't you come and tell me about an ETF? I know what an ETF is. And you first have to help them to unlearn what they know, what they think they know, before you can actually help them understand better what it is. And then, of course, this term passive investing is not doing anybody any favor, because really there is no such thing as passive investing. All investments have an aspect of active decision making in them, some a lot more active than others. But even where I have a pure index tracking, an MSCI all country world index, probably the most passive of passives as you might find. As an investor, I still need to make the active decision that is the index and the ETF in which I'm going to invest. So the sooner we can also get our heads out the sand regarding this idea of ETF equals passive, I think part of the battle will already be won in terms of in education.
Yeah. No, brilliant. As you look ahead to the next 12 to 24 months within the African ETF market, what are some of your expectations? What are you optimistic about? What are you maybe cautious about?
So I'm probably too much of an optimist. So maybe I'm not going to tell you what I think will happen, but rather what I would love to see happen. So I think we've covered quite a bit of this already. We are certainly seeing many more exchanges coming to market, not just for the new ones with new listing requirements and starting on this journey, but even those that already have had the ETF industry for a while are expanding, making access easier, and so on. And I certainly expect that trend to continue. I think the use of distributed ledger technology, the use of technology in general in terms of not only how ETF products are put together, but more importantly, how they are administered, how they are regulated, how they are held in custody. And that's where the tokenization aspect, I think, also comes in very importantly. The third one that I really would like to think we are making good progress on is in terms of improved understanding from the regulators in terms of this facilitation role that they can play in terms of it. I want to maybe single out the Rwanda Capital Markets Authority, who happens to be headed by the same individual who spearheaded exactly the rollout of the ETF industry in Botswana. And he's basically going to the Rwanda market and the East Africa market with the same perspective in terms of to make an impact and make this a successful foray into the market, you need all the role players on board. It isn't just about the stock exchange or just about the ETF issuers or just about the stockbrokers. It is also about the professional investment managers, the retirement fund industry, the regulators, the educators. So having a comprehensive approach to how you position this, how you roll it out into the market, I think is a key differentiator in terms of it. And I think then the final, maybe if you ask me about my bluest of blue sky territory that I would love to see, under the vision of the African Continental Free Trade Agreement, currently the focus is, as it rightly should be, very much on trade. And it's about the movement of physical goods and, sort of breaking down hurdles and stumbling blocks in that aspect. But we know that trade does not happen without payment. And so there's already the payment system, the automated payment system that's part of that project. But for me, the beautiful third leg of that would be to say, but we need capital markets also that support intracontinental transacting. The history of the African continent, and I saw that so starkly when I saw what the rail network in Africa looks like. And I'm now going sort of 20, 25 years ago. The rail network in Africa literally all the railroads went to the ports because it was all about getting stuff out of this continent. And in large part, financial markets are built in the same way. It's all dollar denominated. So any transaction that I want to do in Africa has got not only a dollar leg to it, actually $2 legs if I'm trading with my neighbor, but it also means a US correspondent bank that must be involved in the process. And if we as Africa can bring a lot of that more to an intracontinental focus, I think the opportunities for Africa are just beyond our wildest dreams. And even when, going back to the rail network example, even when they started wanting to connect the existing rail infrastructure between countries and regions, they found that they couldn't even connect them because the gauge of the railway track was based on whoever the colonial power was that laid down that railway track. And so they needed to also build connectors to actually connect the French rail tracks to the British rail tracks. And we as financial markets professionals are required to build those same connectors inside our continent so that we can really become a lot less dependent and therefore a lot less vulnerable to what happens in the rest of the world, and rather focus a lot more on building ourselves and our strength as the continent with the best demographic dividend that we would ever see. So that for me is my biggest wish.
Nerina, that's a brilliant place to stop. I've really enjoyed talking to you, and I've learned a lot about ETFs in the African context. So thank you so much for joining me today. I really appreciate it.